Good afternoon. It is Wednesday, October 11th, 12:12 p.m. There's an article here I'd like to share. Now, Monday night, I read an article, Goldman Sachs, saying gold was going to go down 14% from here. Gold was going to suffer a tremendous loss, and that it was going to go back down to 1,200. That was that hit piece that came out on Monday night, which Goldman has been doing, for how many years now? Then there was the ANG trader yesterday who came out with a hit piece on gold. And I read that article. You can watch my previous video. Now today, we have another article. Gold won't protect you against the stock market crash. Gold won't protect you against the stock market meltdown. Although gold has a place in an investor's portfolio, it won't necessarily be the safest asset to hold when equities correct, says one UBS analyst who favors bonds. So this is a UBS analyst who favors bonds. People, we're in the stretch right here, and this is coming down to a bipolar choice. All right? On the one hand, you have some people, some players, some big name players who are saying bonds are going to crash. Okay? The bond market has been in a bull market for 36 years. Stop calling it a bubble. Okay? The streets are littered with the carcasses of people who have been trying to call the end to the bond market. Okay? Bull market. But you still have those people who are saying bonds are going to crash. The Fed is going to raise rates. They're going to normalize their balance sheet. Central banks all over the world, okay, they're going to become net sellers, right, of bonds. They're not going to be buying bonds. They're going to be net sellers, okay, and bonds are going to crash. Then you have this guy from UBS who favors bonds. He thinks bonds are going to go up. Interest rates are going to come down. Bonds are going to rise. So if the equities crash, they're going to take their money, they're going to put it into the bond market. While gold has a place in a portfolio, its ability to provide protection in a bear market is limited. Jason Draho, the bank's head of tactical asset allocation in the U.S., told Kitco News today, or Tuesday. I wouldn't put an exact percentage on the right amount of gold in a portfolio because there are many other considerations, including an investor's long-term goals. But it's certainly less than 10%. And more like low single digits. 2%, 3%, 1%. That's low single digits. 4%. What's the point of having a portfolio with 1% gold? I mean, why bother? Really, why bother? 1%? 2%? 3% gold? What is that going to do for you? Does that make any sense? I mean, he's basically saying don't have gold in your portfolio. Okay, and I'm not here to say right or wrong at this point. That's what he's saying. Low single digits. Okay, single digits 1, 2, 3, 4, 5, 6, 7, 8, 9. Low, I have to think is less than 5, right? So we're talking 1, 2, 3, or 4. Does it really pay to have that in your portfolio? What's the point? It's a non-factor. Draho clarified that these comments are his own and not that of UBS. Okay, that's interesting. So this is his own opinion, right? Which does not include gold in its official strategic asset allocation models at the moment, he added. He argued that even if gold tends to protect investors in times of recessions, it would be premature to increase allocation to gold today. To turn defensive now could be costly in the form of foregone returns. So I guess he's already pricing in that the stock market is going to continue to go up forever, right? We don't want to miss out on these gains to come. I mean, you got people calling for 30,000 Dow, 40,000, 50,000 Dow. Can't miss out on those gains. The yellow metal continues to trade under the key 1300 level. Last seen down 0.19% at around $12.91 an ounce. Meanwhile, U.S. equity markets continue to trade near all-time highs. Instead, Drahu prefers bonds to protect against an equity market meltdown, which he doesn't see coming in the near term. All right, he doesn't see it coming. Whoa, okay. Green light. He doesn't see it coming. The current bull market in U.S. equities is now in its 9th year, long by historical averages. Not surprisingly, investor anxiety is growing over how much longer it can last. But just being old doesn't mean it has to end anytime soon. He wrote in a recent UBS piece. Just because this party doesn't have to end, okay? We're just getting started. We've just had cocktails. The official recommendation from UBS Wealth Management is a tactical overweight in the equity allocation versus government bonds, premised on the belief that the economic and earnings conditions supporting the bull market will remain in place at least over the next 6 months. For Drahu, the negative correlation between treasuries and equities is stronger than that of gold, and for that reason he prefers bonds. Unlike bonds, which will benefit from lower interest rates, there is no clear pattern for how the price of gold could behave, he said. If the risk of deflation increases, the price of gold could actually fall. No, not true. Gold doesn't make sense as a strategic holding in a portfolio because over very long time periods it has low correlation with stock returns. But that doesn't mean it has to perform well in a bear market. All right, so another hit piece. All right. There's another little snippet I'd like to read. Bill Dove, who is this? Charlie Evans, right? Gold market interest rates ignore Fed's Evans dovish comments. So here we have another Fed head. All right, this is what they do. I said that they go all over the world on the taxpayers' dimes. One guy says one thing, the next person says something else. They want to give you the opinion. There's really intelligent debate going on and discussion. This is all nonsense. If you're a backbencher at the Fed, maybe you get a 2-day junket to Vegas or something, okay? Gold prices and markets in general are ignoring dovish comments from Federal Reserve voting member Charlie Evans. Speaking to Bloomberg, the Chicago Fed president said that he could see the central bank leaving interest rates unchanged in December. He could see the central bank leaving interest rates unchanged in December. The current probability, the market is pricing in a 92% chance they're going to raise rates in December, and he could see them not. Okay. At an event in Zurich, Switzerland, there it is again. Why does he have to be in Zurich, Switzerland right now talking about U.S. interest rates? Evans said that falling inflation expectations are making him nervous. He added that he is concerned those expectations could solidify among consumers, which would make it more challenging for the Fed to push inflation back to target. We talked about that. The Fed gets to decide what their target inflation rate is. 2%. Some magical number, 2%. Not 1%, not 1.5%, not 2.5%, but the Fed decides that somehow 2% inflation is that magical number. Okay? They get to decide. He added that the central bank needs to get inflation back to 2% as quickly as possible, and noted that he also wants price pressures to even rise above the central bank's target. The uber arrogance of these people that they think they can calibrate and tweak this market, okay? He wants price pressures to rise even above 2%. Where did they get this from? Some junior year college textbook? Despite Evans' outlook of uncertainty, he remained optimistic on the U.S. economy. There's room for a very honest discussion later this year. There's room for a very honest discussion later this year as to whether or not it's the right time to raise rates. Why don't we have, when was the last time there's been an honest discussion in these markets? When was the last time, okay, the Fed has had an honest discussion? There's room later this year for an honest discussion. This makes me puke, this nonsense, quite frankly. It makes me puke. Evans' dovish comments have not shifted expectations for a December rate hike. CMA 30-day Fed funds futures are pricing in a 92% chance of a final rate hike at the end of the year. Expectations have spiked recently after they were at 78% just 1 week ago. The U.S. Consumer Price Index has fallen from a high of 2.7 in February to 1.6 in August. Core CPI, which strips out food and energy costs, have fallen from 2.3% at the start of the year to 1.7% in August. Evans' comments have also not impacted gold prices, which are seeing some modest selling pressure after 2 days of solid gains. December gold futures last traded at $12.92. Markets are waiting for the afternoon release of the minutes from the Central Open Market Committee meeting, expecting further guidance on the interest rate trajectory. All right, they're going to have the FOMC meeting minutes later today. Let's see how they talk out of both sides of their mouth. Okay, that honest discussion. I truly believe we're getting down to this bipolar choice. All right, which way bonds are going to go. Do I personally believe that gold can protect you in a stock market melt? No, I don't necessarily believe that. Okay. When in '08, right, gold went down, stocks went down. They both went down. Okay, and then they both reversed. Okay. So these people that think that they can, they can call every shot, the bond market is going to go down, and people are going to put their money into, assets that are undervalued. No. Stop the nonsense. You don't know what's going to happen. Nobody knows what's going to happen. Okay? Well, there's my phone. I guess that's ringing the bell. They always ring a bell at the top and the bottom. Ciao for now. We'll pick this up later.